Hi there, QuickBooks experts. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. In this video, we're going to cover Chapter 9, Analysis and Recording of Adjusting Entries for the QuickBooks Online for Accounting 2026. Upon completion of this chapter, you should be able to prepare an unadjusted trial balance and make the following adjusting entries for prepaid expenses, accrued expenses, unearned revenue, accrued revenue, and depreciation. In Chapter 8, we added a budget. And as we know, a budget is essentially where an individual or business, they track the money that is coming in and they also track the expenses that are going out. I sincerely believe that you cannot manage what you do not track. So with the budget, that is essentially where you say, simple example, I only want to spend $100 on going out to eat. And now you have a benchmark, something that you can compare the actual numbers to. So if you spend $120, you are over budget, you're off track. If you only spent $80, then you are on target, right? So we looked at this budget. Businesses do it, a profit and loss budget report. And we also prepared a bank reconciliation to the Wild Water Sports Company. So with the bank reconciliation, this is an internal control procedure whereby you ensure that your bank statements, the bank's records, ties to what the company's internal records are. So in this chapter, we're going to add adjusting journal entries prior to the creation of these financial statements, because again, we know financial accounting, this is where externally users are utilizing the financial statements to make decisions. Let's think about a bank. They are a lender. Before they lend money to a company, they're going to assess the financial statements to say, hey, if I lend this company money, do they have enough money to pay me back? Right? Same thing, like essentially when you are going to apply for a credit card. Before they give you a credit card, what do? They run your credit. They want to see if you are responsible, right? And then we have what's called generally accepted accounting principles gap. And this requires that the accounting records be adjusted to reflect accrual accounting. So when I teach accounting one, the basics, the principles of financial accounting, just to kind of emphasize or make it more practical, let's say you're in the you're dating, you're single, you're ready to mingle, and you want to settle down, you want to be with someone long term. Now imagine this person that you met, they seem lovely, they seem amazing, but they didn't tell you they were married, right? So if you would have known that person was married, 9 times out of 10, I mean, depending who you are, everybody's a little different, but right, if you would have known that this person was married, you probably would not have taken them serious, you would not have engaged. So that information that was left out, it has a material impact on the decision that you would have made. So as it relates to adjusting entries, when these financial statements are being prepared and when they are being provided to the public, those external stakeholders that are going to make decisions, there's certain information you want to make sure that the financial statements are accurate, right? That they are correct, that it reflects the true nature of what is happening. So essentially with these adjusting entries, this is a part of the process of ensuring that revenues are recorded in the period in which they are earned. This is governed by the revenue recognition principle, and that expenses are recorded in the period in which they are consumed or incurred. This is the matching principle. So in this process, expenses, they're going to be matched in the same period to the revenues generated from incurring those expenses. So there are typically 5 types of adjusting entries. We have what's called accruals, we have deferrals, and then we have depreciation. So with these 5 adjusting entries, we have expenses paid prior to being consumed should be deferred. So let's say we purchase supplies in bulk, we pay rent for 6 months or the year, insurance, etc. We pay for them before we actually consume it. And then we have those assets that we essentially, again, we were going to record them as an asset because it can be used in the future. We did not consume it as yet. So supplies would be recorded as a supplies asset. Rent paid in advance would be prepaid rent. Insurance would be prepaid insurance. To defer is basically to postpone. So anytime we hear of a deferred revenue or deferred expense, we are basically postponing recognizing the expense, and we are deferring, postponing recognizing the money as income or revenue because we have not yet earned it and we have not yet incurred it. Then we have expenses that are incurred prior to being paid. So payroll, rent, utilities, these must be recorded and accrued as a liability. We incurred it, we just have not yet paid it, but we have a liability to do so. To accrue is to increase. Revenue collected prior to being earned, this is considered deferred. So a great example of this, there's not a lot of magazine subscriptions nowadays, at least not physical ones, but let's say you purchase or pay for magazine subscriptions in advance. The company, the magazine publisher, they are earning the money on a monthly basis. Every time you mail out, or they mail out rather, the subscription, that is when they are earning the income. And revenues earned prior to being collected, sales and services, these are recorded and accrued as a receivable. So all of this is just tying back to the principles of accounting one. So if you find yourself struggling, I would definitely suggest take the time to go over the basics, just so that way, as you're recording these journal entries, you get a better understanding of what's happening. Lastly, we have what's called fixed assets, buildings, furniture, equipment, vehicles, etc. They need to be depreciated over their useful life to match costs with revenues. So again, we have our accruals. And when you think of accruals, one of the ways in which I remember accruals is accrual starts with A, and the word after also starts with A. So when we think of accruals, think of the cash being exchanged after. So as it relates to revenue, I provided rather services to a customer, sold the product to a customer, and they pay me after. I incurred my phone bill expense, my rent expense, and I pay it after. So that's a little trick to remember. Accruals starts with A, after starts with A. So when we're dealing with accruals, the payment happens after. When we're dealing with deferrals, that's the opposite. Payment happens before. So the customer pays me before I earn the revenue, and I pay for the expense before I incur it. Depreciation, this is a standalone adjusting entry. All right, so we're going to jump right in. Trial balance. In this section, we're going to create a trial balance before the adjusting entries. And again, we're going to analyze it in light of the end of period. And we want to make sure that everything is correct. So I already have my internet browser open. I am already in Wild Water Sports. So we're going to go to our reports, and we want to make sure that everything is accurate. So we click on our trial balance. And we scroll down, and perfect. Here we are. We see that everything ties. $751,009.66. And again, I always start off with checking the debits and credits, and then we go through everything one by one to make sure it all ties up. So I look at my checking, AR, inventory, etc. I already did that beforehand, but you want to make sure that before you move on with another chapter, you must make sure your trial balance ties, because if it does not, then you're just going to make a whole big old mess, okay, for lack of a better word. So this is your starting point. Always want to make sure that everything ties. So we're good to go. Trial balance ties, nothing left to be done. So further investigation of this trial balance period and business activities, it indicates that $500 of vehicle, gas, and fuel were recorded as an expense, but it should have been deferred as a supplies asset until consumed in some future period. So with that being said, we need to record an adjusting journal entry. So we're going to click plus new. Sorry about that. All right, so here we have plus. So again, the words don't show because of the split screen, but typically we'll see the create, but then as we split the screen, that's why we see that here. So there we are. And then we're going to input a journal entry under other, and this is going to be for 1/31/2027. And this is journal entry number 6. So if you've been following along with everything, then this is automatically going to show. So then we're going to type in the supplies asset account. All right. And as we see, we don't have one. So we're going to add. And the name is going to be supplies asset. So we select the account type, which is going to be other current assets for both the account type and the detail type. And then from there, we select save. All right, this got updated. Sorry about that. Supplies, asset. Perfect. Now we click save. Okay, this is giving us, let's see if it's saved. All right, so we're going to start this over. Oh, I think I need to input it correctly here. All right, so supplies asset. We add new supplies asset. This is giving me a little trouble, but it's all good. All right, supplies asset. There we go. We have other current assets. Other current assets, save. Perfect. There we go. All right. So we type $500 in the debit columns. All right. So if we think back to accounting, this is going back to the very fundamentals of accounting. Anytime we want to increase our dividends, our expenses, and our asset accounts, we must debit those account types. And as we know, in accounting, each account only has two sides, much like a coin. There's no in between. When we're dealing with a coin, there's either heads or there's tails. When we are dealing with accounts, there are either two sides, or there are only rather two sides. We have debits and credits. One side increases and the other side decreases. So for our dividends, our expenses, and our asset accounts, they increase on the left side, the debit side. Therefore, if we want to decrease it, we do the opposite. And then for our liability, our equity, common stock, and our revenue accounts, those accounts are increased on the right side of credit, and therefore we decrease them by doing the opposite. So just keep that in mind. And then from there, again, we select vehicle and gas as our second account. And we see vehicle, gas, and fuel. This is an expense account. And as we just pointed out, expenses are increased on the debit side and decreased on a credit side. So simply, we are removing this $500 from the expense account and putting it into the asset account. All right, so this is our journal entry. We select save and close. So the same process could be used to defer a cost that has been recorded as an expense, but should be deferred as an asset at the end of the period. Some examples might include insurance that needs to be deferred. And as we pointed out earlier, deferred means to postpone, to delay. So examples might include insurance to be deferred as either prepaid insurance or prepaid expenses, or rent to be deferred as either prepaid rent or prepaid expenses. Another example of this occurs when an expense is deferred in the prior period, but is being consumed in the current period. So we're going to use the prepaid expenses created as an example, assuming that $1,000 of the prepaid expenses, in this case, insurance costs paid to Allstate for future coverage, were consumed in the month, leaving only $16,500. So here we see $17,500 of prepaid expense, but we've used up a portion of it. So therefore, there's only $16,500 left. We need to reflect the correct amount of prepaid expenses, right? So when we think about it, if we are dealing with supplies, right, and we have supplies in the amount of, let's say, we make a bulk purchase of, chips or something of that nature. Typically, I'll go to BJ's or Costco or something of that nature. So in the event that I go and I purchase a bulk 50 count of chips, by the end of the week, it's probably not going to be 50 chips left, right? Maybe there'll be 45, maybe 30, right? So that is ultimately why we make these adjusting entries. We want to ensure that the correct amount is being reflected. So to record the adjusting journal entry, we're going to click new, go to our journal entries. And as we know, there's, multiple ways to do the same thing in QuickBooks. So you can also search. There's other ways to get to the journal entry. All right. So here we see it automatically selects journal entry number 7. We select insurance. So we're now recording the expense because we've used it up, and we type in $1,000. So tying back to the fundamental basics, we're debiting the expense because the balance has increased, and we're crediting our asset, the prepaid expense account, to indicate the decrease in the balance. So we scroll down, make sure everything ties, which it does, and we select save and close. So closing the journal entry is going to reveal the trial balance we created before. So now we see the prepaid expense balance is 16,500, and we now see that there's $1,000 insurance expense that is being reflected. So the next thing we're going to do is asking us to click the supplies asset $500. So we scroll up and we click on this. All right, and then it's asking us to switch to the classic view. So if we scroll up here, we see switch to classic view. And with this classic view, it's going to show us the details, the transaction type, the number, the account, etc. So it's asking us to go back to the summary report. We're going to go back to the trial balance and we're going to click on the prepaid expense account for 16,500. All right, it's moving a little slow. All right, so here we are. So we see the bill from Allstate. This was the initial entry on January 19th. And now at the end of the month, we have to say, well, we had an increase of 2,500 and we've used up 1,000. And overall, that gives us an ending balance of $16,500. So we see that the first entry deferred $500 from vehicle expense, and the second entry recorded the expiration or the consumption of insurance, reducing the prepaid expenses account. So now we move on to accrued expenses. And as we pointed out, accrued expenses, this is ultimately whereby the exchange of cash happens after. So further investigation of this trial balance and period end business activities indicates that a bill for $2,500 was received and recorded in the next month for advertising consumed in the current month. Thus, an adjusting journal entry needs to be made to accrue this expense. So we've utilized these services and we need to pay for them. So for our purposes, we're going to create a new accrued liabilities account to keep track of these accruals, and we're going to keep them separate from accounts payable. So we pick up where we left off, we select plus new, and as mentioned, you can also use the search box, journal entry, so again, there's more than one way to do the same thing in QuickBooks. So here we are. It's already journal number 8. We select advertising and marketing. This is an expense, and we increase our expenses on the left side, the debit side. And this is another thing to keep in mind. In accounting, debit does not mean increase. It does not mean decrease. Debit simply means the left side of an account, and credit simply means the right side of an account. Whether or not the balance in that account is going to increase or decrease, it ultimately depends on the account type. So very important to keep in mind. So then we're going to move on. And now we're going to create this brand new account. So the name of the account will be accrued liabilities. This is going to be other current liabilities. Other current liabilities. We select save for the 2,500. And we're going to accept the 2,500. And then from there, we select save and close. So we just closed the journal entry, and here we see the trial balance from before. And now we see we have accrued liabilities of the 2,500. And then we also see that we have advertising and marketing expense of the $2,500. So it's asking us to click on the 2,500 for advertising and marketing. And it is going to reveal to us the transaction report that lists journal entry number 8. All right, so we're going to go back to the summary report and we're going to get back to the trial balance. So now we're going to look at unearned revenue. So this is also an example of deferred revenue. The customer paid us in advance. We think about magazine subscriptions. We essentially think about anything that we pay for in advance, or customers rather pay us in advance, where we're looking at it from a business perspective. So further investigation of the trial balance and period end business activities indicates that the sale of a boat recorded on sales receipt 1001 for $55,145 to Southtown Water Sports had not been delivered, even though cash had been received. Thus, the revenue was not yet earned. So revenue is earned whenever the service is provided or the product is sold. Delivery is expected to occur next month. Thus, this amount of revenue and related sales tax must be deferred and set up as an unearned revenue liability. So we continue where we left off. The trial balance, we're going to click on the sales amount of $164,000. So we click on this amount. It's going to reveal the transaction report, and we're going to click on sales receipt 1001. So here we are, we click on the sales receipt, and we note that the receipt recorded cash received of $55,145, sales of $52,000, and sales tax payable of $3,145. So we just scroll down so we can essentially see the $52,000, and then we see that the tax was calculated down below. So we close this receipt. We're now going to create a journal entry. We accept the date, the journal number. So the first thing we're going to do is we're going to decrease the sales. So remember, our liability, our equity, common stock, and our revenue accounts are increased with a credit. So therefore, the only way we can decrease the balance in one of these accounts is with a debit. So therefore, we are going to decrease the balance in our sales account by $52,000. We're going to select Southtown Water Sports as the customer. And then we are going to type in unearned revenue and create a brand new account. And this is going to be other current liabilities. And then the detail type is going to be deferred revenue. And we select save. And then it's automatically going to select the $52,000. And we could also input Southtown Water Sports. So that way, and it's a good practice as a business. So that way you can track what is owed to customers. So this is our journal entry. Everything looks good. We select save and close. So closing this journal entry is going to take us back to the sales transaction report. And then we are going to want to go back to the trial balance. So here we see as we go back to the trial balance, now we see unearned revenue. Our liability shows $52,000. So now we consider accruing revenue. Again, when we think of accruals, we think of after. So we provided the service to the customer, but they're going to pay us after. So further investigation of this trial balancing period indicates that a Tide 25ZX boat was sold, delivered to a new customer, High Flyer Sports, on January 31st, 27, net 30 terms, but not invoiced until next month. Sales tax on that sale amounted to $13,525, and the boat was sold for $225,000. So therefore, we sold the product. We just did not get paid yet. We get paid after. So with that being said, we're going to record an adjusting journal entry to record accrued revenue and an accrued receivable. So we're going to go back to our journal entries. And again, just showing you the different ways in which you can access it. So we create journal entry. We already have the date. We have the journal number. So we're going to type accrued receivable. We're creating a brand new account. It's going to be other current assets. Detail type is also other current assets. We select save, and the amount is $238,525. And the name of the customer is going to be High Flyer Sports. So company name is High Flyer Sports. You select save. And then from there, we select sales. And it's automatically going to pick up the amount. However, we have to keep in mind that a portion of it is attributable to sales tax. So $225,000. We type in the name of the customer. And then the remaining portion is going to be attributed to sales tax to pay. So $13,525, it automatically picks up. And we just type in the name of the client again, or the customer. So this is our journal entry. We debit accrued receivable, money that we are expecting to receive. $225,000 of that is allocated to sales, our revenue, and $13,525 is allocated to the tax liability. So we select Save and Close. And then after we do that, now we see that there's this accrued receivable of $238,000. We click on it to reveal the transaction report. And again, it just shows us the journal entry that we just created to track the amount of money that customers owe us. And this is a very, very big thing. I, as a tax professional, business owner, I've been burned. Why? Because a lot of times haven't been or have not properly tracked the amount that customers owed me and ended up losing out. Because how can I now, 6 months, a year later, send a client a bill? I mean, yeah, you technically can, but sometimes it becomes water under the bridge. So very important as a business owner to track how much customers owe you. So we select back. And now this brings us to our last adjusting entry. So further investigation of this trial balance in period end business activities indicates the company's fixed assets need to be depreciated for the month. Monthly depreciation for equipment and furniture is $1,000 and $250 respectively. Normally, the adjusting entry would debit depreciation expense and credit accumulated depreciation. However, the accounts set up in the chart of accounts need to be edited. Thus, we're going to decide to change the account names first and then record the depreciation. So we're going to go to our chart of accounts. Again, multiple ways to do different things. So with our gear icon, we can go here, go to accounting and chart of accounts. We can also type it in. All right, so either or. So we go to our chart of accounts. And then we're going to click edit from the drop down arrow next to the words view registered for depreciation. So what I would do, make it easier for myself, look up the depreciation account. Okay, perfect. Here we are. All right, so we see depreciation line listed under the furniture account. So here we see it already shows us the depreciation. So we type accumulated in front of the depreciation. So this is already here, accumulated depreciation. So in the event that yours needs to be updated, drop down arrow, select edit, and then you make the change. All right, but accumulated is already here, so we're good to go. And then here we scroll down and we're gonna look at the expense. So here we only see depreciation, so we're gonna make an edit to this one. We select edit, and instead of just depreciation, it is going to be depreciation expense, and we select save. So since we edited those names, we can now go to our journal entry. The journal entry number is there, the date is there. So the first thing we're going to do is debit the depreciation expense account, because as we've discussed, expense accounts are increased with a debit for the $1,250. And then from there, we're going to select the accumulated depreciation account. So we have the accumulated depreciation sub-account of equipment for $1,000. And then we have the accumulated depreciation, all right, for furnitures and fixtures. So what we're going to do, let's fix this one, because it seems as though this one is not updated. It needs to be a sub-account of furniture. All right, so I'm just quickly going to go back to the chart of accounts. Nope, sorry about that. Okay, so let's see. So I'm just going to fall under depreciation. All right, so I'm just going to quickly look to see. And typically what some companies will do is that they would have different accumulated depreciations for the different classes of assets that would make the most sense. All right, so we see we have one for equipment, then we have one for furnitures and fixtures, etc. So with that being said, This accumulated depreciation needs to be linked to this one, so we're going to update it. We're just going to scroll down. Okay, now I can't see. All right. All right, so we're going to make this a little bigger so we can see both. Perfect. Okay, so we're going to edit this, and this is going to be a sub account of furniture and fixtures. There we go. Perfect. So now when we edit this journal entry, furniture would have its own sub account of accumulated depreciation. So here we go, furniture. Or you could even type in accumulated depreciation, either or. Perfect. So there we see it, furnitures and fixtures, accumulated depreciation. So just in the event that, yours has the same issue, you'll want to go back and make the accumulated depreciation account a sub account. So from there, we're going to click reports. We're going to go to our custom reports that we should already have saved, just, making things a little easier. And then now we're going to confirm if everything ties. So as we know, the first thing we always want to tie is our total debits and credits. So we scroll down, $993,284.66. Perfect, debits and credits tie. And now we go through each account one by one. Check my check-in, AR, accrued receivable, inventory, payment to deposit, prepaid expense. So you essentially just go through them one by one. I typically do all of my debits first and then compare all of my credits. So everything seems to line up on the debit side, good to go there. I do the same thing for my credit side. Make sure that everything ties. Perfect. And now that everything ties, we are good to go. So this brings us to the end of chapter 9, where we are dealing with the analysis and the recording of adjusting entries. So in this chapter, we recorded adjusting entries to create accrual accounting based records. So one key thing to keep in mind, there are two bases for which a company can keep their accounting records. The first is the cash basis. Simply stated, the only time a company records revenues and expenses is when there's an exchange of cash. However, as we know in the real world, that's not an accurate reflection of business operations. So therefore, under GAAP, generally accepted accounting principles, businesses are required to follow the accrual basis method of accounting. So the key thing is that, was revenue earned? Did you sell the product? Did you provide the service? If so, revenue must be recorded. It does not matter if the customer paid you before or after. That is the revenue recognition principle. And then we have expenses. Was the expense incurred or consumed? In such case, it does not matter if you paid for the expense in advance or you paid for it after incurring or consuming it. Based on the matching principle, the expense must be recorded in the period in which it helped to earn revenue. All right, so in the next chapter, we're going to create financial statements and useful reports. So this brings us to the end of chapter 9.